Hey, good evening, everybody. Uneducated economist. I was able to get the sunset. Of course, these aren't quite the nice sunsets that we get during the summertime because the sun, unfortunately, is kind of over there on the other side of the hill, and you don't quite get the nice sunset coming right down the mouth of the river. But it's still not too bad, and with the bridge in the background there, it looks pretty cool. So this is going to be part 3 of the Federal Reserve from Bank of New York speech, monetary policy strategies for a low neutral interest rate world, given November 30th, 2018 by a John C. Williams, President and Chief Executive Officer. Now, if you haven't watched part 1 and part 2 yet, you might want to go and check that out. It might make the information a little more relevant. But here we go. Today's low neutral interest rates reflect the culmination of trends extending back 25 years. A quarter century ago, a typical estimate of the neutral rate in the United States was 2 to 2.5%, consistent with the historical averages over the preceding half century. Since then, however, there has been a clear downward trend in neutral interest rates in the United States and other advanced economies, with current estimates ranging from 0 to 1.5%. Three main global trends appear to account for the bulk of the decline in the neutral rate over the past quarter century. One is demographics. Populations are aging as people live longer and birth rates have fallen. The second is productivity growth, which has slowed around the world. The third is the heightened demand for safe and liquid assets, which has led to a wider wedge between yields in safe government securities or central bank reserves and yields on riskier assets such as corporate bonds. Importantly, the onset of these trends preceded the global financial crisis, and they have continued even as the countries have recovered. Although there is a great deal of uncertainty about the neutral rate and conditions may change, a reasonable assumption is that it will remain low, not far from current levels for the foreseeable future. What does a low neutral rate mean for monetary policy and anchoring of inflation expectations? When a recession hits, a central bank may not be able to reduce the interest rates well below their neutral level to stimulate the economy as warranted because of effective lower bound on the nominal interest rates. This shortfall of monetary accommodation will result in less than desirable economic outcomes during the recession and recovery. In particular, inflation would typically undershoot its desired target during these episodes. The persistence of below target inflation rates The persistence of below target inflation rates in many advanced economies over the past decade is a testament to this dynamic. As a result of the inherent asymmetry introduced by the lower bound on the interest rates, the inflation-targeting central bank could experience inflation that is below target. Once we consider average inflation rate over periods when policy is constrained and those when it is not. With inflation on the average below the target level, inflation expectations will likely slip below the target rate as well. So let's kind of break this down. If we go back to the beginning here, it's pretty straightforward. He talks about how over the last 25 years that we've had this kind of consistent 2 to 2.5% inflation rate, and basically saying that has dropped down to 0 to 1.5%, and he includes the United States in that. So 0 to 1.5, and I'm sure that they're talking about the growth inside of that, even though they kind of refer to it as the neutral interest. I'm sure that they're referring to the growth as far as that goes. They just don't say it that way. Three main global trends appear to account for the bulk of the decline in the neutral rate over the past quarter century. And he goes on to talk about the population and aging population, which totally makes sense considering that baby boomers are getting older and dying off. And, generally when you kind of get older in life, you don't really go and do the traveling and hanging out at the bars and buying new cars and buying new houses, and all this stuff is kind of like, that's done like earlier in life. And later on in life, you just kind of hang out at a house, you don't really do much. And that's kind of leading to this productivity growth decline. And then it goes on to say here, the third reason for this is the heightened demand for safe and liquid assets. And I laugh every time I read this because basically the demand for the safe and liquid assets came from the Federal Reserve. They printed up a bunch of money and started buying treasuries with it. They're the one reason why there's such a heightened demand. I just laugh every time I read that. But it kind of goes on here. And it says, although there is a great deal of uncertainty about the neutral rate and conditions may change, the reasonable assumption is that it will remain low, not far from current levels for the foreseeable future. So basically what he is saying right there is that we don't see growth happening. Even with our forward guidance, we don't see it happening for the foreseeable future. I mean, we are down here at this low neutral rate, and it doesn't appear to change or going to change. So what does a low neutral rate mean for monetary policy and anchoring of inflation expectations? When a recession hits, central banks may not be able to reduce interest rates well below their neutral level to stimulate the economy as warranted because of the effective lower bound. So what he is saying by that is that when the next recession comes in and we need to lower interest rates in order to stimulate the economy, we're stuck because we have a zero, right? You can't go below zero because they're bound by it. Now, is there such thing as negative interest rates? Sure is. But what he is saying in here is that the current system and the policy that is in use right now has a bound. They're bound by zero. They can't go any lower than that, right? And then, if they try to stimulate inflation by dropping these interest rates and getting people to go out there and take loans, the inflation target may not come in where they want it to because they can't drop it down enough, you see? And that's what he kind of goes on to say. As a result of the inherent asymmetry introduced by the lower bound on interest rates, an inflation targeting central bank could expect inflation to be below target, right? So he's just saying that because we can't go any lower than zero, we may not be able to get the inflation that we need, and it'll come in under that target that we're shooting for. And once we consider the average inflation rate over periods when policy is constrained and when it is not. So he's saying when it's not constrained, yeah, we got plenty of room to move, but here it is constrained and we got a whole different game to play here. With inflation on the average below the target level, inflation expectations will likely slip below the target rate as well. So yeah, this is pretty telling inside of here. Basically what he is saying is that the interest rates that have been dropped down to trying to stimulate the economy have not ticked up enough to have enough firepower to deal with the next recession that may come in. And that's pretty much where we're going to leave this off right now for part 3. So be sure and come back for part 4 where we start breaking down what the actual plan is to deal with the fact that we have interest rates so low, we have this bound at zero where we can't go below it, and with this policy anyway. And yeah, I mean, this is getting pretty exciting here. So let's see what happens in part 4. Thank you guys for watching. I hope you enjoy the sunset. It's a great picture. Talk to you guys later.